A very good evening to you all, friends. I'm Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board, a Central Council member, I'm also the Vice Chairman for the Committee for Member in Industry and Business. I welcome you all to the 109th program of WASB in this council year. So in 3 months, it is our 109th program. More than 33,000 members have attended these programs. About 2/3 of these programs have been on the physical mode, on bank audits, and about 1/3 of the programs have been on the virtual mode. And friends, it's been our endeavor to build the capacity on the audit-related aspects. What we have also done is that we have an expert helpline for the statutory audits, which is running from April 16 till 30th of September. So 50 experts are there who are willing to resolve your audit-related queries on a pro bono basis as a goodwill gesture from the Institute of Chartered Accountants of India. So, kindly ask your queries. When in doubt, ask your queries. And friends, we also have come out with the auditing standard checklist and basically also the templates of the working paper for the audit working paper. Kindly make best use of the same. We have also done a tie-up for the audit documentation software. You can visit the ICI website for more details. Our whole objective is to improve the audit quality. And today we are going to discuss the FRRB observations with respect to audit. And to deal with the same, we have two very distinguished professionals, of course, with a very different experience. CA Jitendra Agarwal ji, as I call him, Jitu sir, is a veteran in audit, having an experience of more than 3 decades, maybe close to 4 decades. And I had the opportunity of, working with him on many programs of the Institute of Chartered Accountant of India from last 15 years. He was a key resource person at the Ind AS or the IFRS certificate program in Delhi, which we started in somewhere in 2009. And since then, I get his mentorship and the guidance. He has done one of the most complex engagements, and he has worked on the multiple gap. Thank you so much, sir, for being here after spending so many decades in the profession and taking out time for the ICI programs. Friends, he has also been a jury member of the Research Awards or the Financial Reporting Excellence Award for the Institute of Chartered Accountant of India. Thank you so much, sir. And then we have a very, very young and dynamic colleague of Jitu, sir. Of course, he's been my colleague also, C. Amit Jain, who is an enthusiast in the Ind AS, in IFRS, and, uses that knowledge for the purpose of deliberating on the topic relating to the audit. I know that when we have done our 100th program of WASB last year, because last year also we crossed this 100 milestone. Of course, this year we crossed in 3 months. And then when the 5 distinguished past chairmen of WASB were there, it was Amit Jain who has taken up a session. I'm not sure, maybe Jitu sir was also there, but I'm not sure. But
he was there.
Okay, Amit is saying that he was there. And, Amit mesmerized the esteemed panelists with his deliberation. So Amit had a long way to go, and I'm sure that he will shine more and more in the profession. And we have with us two very young moderators, Nikhil and Malvika, who will be moderating this session. Moderating in the sense, introducing the speakers to us and asking the participants' queries to our esteemed speaker, Jitu sir and Amit. So it's indeed a pleasure to have 4 fellow professionals on the screen and thousands of fellow members as the participant. Thank you so much for your continued interest in the audit-related webinars. We know that audit is a very serious profession, and the kind of seriousness it brings at times. There used to be days when the interest level in the audit-related programs was less, but fortunately, we have been able to bring that interest and organize more than 100 programs every year. So with this, I thank all the panelists and the moderator and the participant. And now I invite CA Malvika to take the proceeding further. Thank you.
Good afternoon, everyone. I welcome you all on the webinar Enhancing Audit Quality, Key FRRB Observations with Respect to Audit. I would like to welcome CA Jitendra Agarwal sir and CA Amit Jain. I would be introducing CA Jitendra Agarwal sir. Jitendra sir is a partner with audit and assurance practice of the firm and is based out of Deloitte office in Gurugram. Sir has post-qualification experience of over 35 years with over 24 years as partner with Deloitte. He currently leads various initiatives for Deloitte. As the lead partner for some of the firm's largest clients, Jitendra sir has been responsible for the audit of several domestic and multinational companies spanning across multiple sectors, mainly automobiles, energy and resource, technology and media, manufacturing and consumer business. In addition, sir is an advisory and quality control partner on various other large clients of the firm. He has an in depth knowledge and experience of reporting under various regulatory frameworks, including Indian GAAP, IFRS, US GAAP, and those of other significant capital markets. He has worked extensively on financial statements audits carried out under the requirement of the Public Company Accounting Oversight Board with record of clean inspections. In addition to audit, Sir has managed various assignments in other areas, including internal audit, internal controls, forensic reviews, due diligence reviews, and agreed upon procedures. He has extensively advised companies, including public sector undertakings, on IFRS implementation and conversions. Sir has been a member of Accounting Standards Board and Auditing Standard Boards of the ICAI. He has also been a speaker at ICI and other industry forums and has been faculty for the IFRS course conducted by ICI. Sir is a fellow chartered accountant from the ICI and Commerce graduate from Sri Ram College of Commerce, Delhi. I welcome you, sir.
Thank you very much, Malvika. Thank you, Sanjeev Bhai, for such a wonderful introduction. Every time you come on screen, you humble me. You talk so well about me. I really wonder, whether we are all worth that praise. But thank you so much for all that introduction. Sanjeev has been a wonderful colleague right from the beginning. I know him for over 2 decades now, if I'm not wrong, Sanjeev. And it's been
Yes,
wonderful knowing him, such an accomplished person like him, talking so well about everybody else, irrespective of age. ये इनकी खास बात है जो सब इतना पेडेस्टल पे ले जाते हैं. It is so nice of us. जितनी बारी मैं मिलता हूँ उतनी बारी आपसे मिलके अच्छा लगता है. And it is so nice to see. Yeah, and it is so nice to see three such. Yes, same here. And it is so nice to see 3 such young budding professionals. I can say one thing, that and these 3 professions are the future of the profession. They are the future of the profession. And I see the younger professionals that are coming up, people like Nikhil, Malvika, and Amit. They are so much more accomplished, and they are giving the profession such a good name and the institute such a good name in the marketplace. I can't tell. Our institute is a wonderful institute. I am very fond of the institute. I am very fond of this profession. Some people say it is a very, very difficult profession. Yes, it is. And that is why we are honored. And it is because of the quality we bring to the marketplace. We are under stress right now, but that stress will only get taken away if we continue to support the profession, the industry, and the country with the quality that we produce. And we will always remain extremely valuable to the country as well. So can I start with my presentation, Sanjeev Bhai?
Absolutely, sir.
Okay. So, this is something which is core to my heart. Let me put it like this. Quality, control on financial statement audit. This is what I have done throughout my life. And I have loved doing this. I have done this by choice. I have not done this by force. I have not done this to earn money. I have done this as a passion to serve the institution. Mostly for the audit profession. There is so much nice that the word is on the financial statement 100% by any chartered accountant that it has value in itself, and to retain the value and to enhance the value, we have to make sure that we produce quality in whatever we do, and the firms and individual professionals are responsible for this quality, and we make sure that the quality at every time, with every year, with every signing statement, improves over the past. And I believe that it is happening, not only because there is regulation which is controlling us, but because each and every chartered accountant takes pride in what he does and he produces the best quality. There is a standard on quality engagements, or there are quality control requirements. The point is, what is it that we are required to do? That is what I will in the next half an hour's time. For the interest of time, not to feel, not to get people not interested in this topic, I will skip the routine slides and I will come to the more important factors as we read this, as we talk about quality. So this presentation will deal with the specific responsibilities of an auditor regarding quality control procedures. Quality cannot be maintained, if the firm does not have quality control procedures in place. And this is to be also read together with the ethical requirements. The role of the quality control system and the role of the engagement team. There is an engagement team which does the audit. There is an engagement partner which leads the engagement team. What is the responsibility? The responsibility is to ensure that the firm and the individuals comply with the professional standards. Who has said, I don't know this. Can the host put on my video? I am not being able to put it on. It says that the host has stopped the video. Okay, here it is back again. So what is the responsibility of the audit firm and the professional? It is to ensure that the firm complies with all the regulatory legal requirements, the accounting standards, the auditing standards, any professional standards set out by the firm. Reports are reports that take shape. What is the responsibility of the engagement team? So this is the responsibility of the engagement firm. The engagement team has to be. I will do that. I will. Okay. I hope it is better now. And I will come closer to the computer so that it is even better. So what is the responsibility of the engagement team? The responsibility of the engagement team is to make sure that all the quality control procedures have been applied and to provide the firm with relevant information with regard to reliance on independence. So these are the responsibility of the engagement team and the engagement partner and the firm. So if everybody takes reasonable responsibility, I'm sure there will be no slippages on account of quality. The engagement team every firm or every practicing unit has its own quality control procedures. So the firm these quality control procedures are in line with what the institute prescribes. Plus, on top of that, there are more quality control procedures which the firm has. So at minimum, the individual should comply with the firm's quality control procedures, which should be in line with the institute's quality control procedures. What is the auditor's objective in terms of quality? It is to implement the quality control procedures at each engagement level. It's not that we have overall quality control procedures, but these have to be applied for each engagement that we do, which provides assurance that the audit complies with the professional standards and the audit report issued is particular to that related circumstance. For example, if you do a tax audit report, it is to be issued in accordance with the tax audit requirements. If there is a transfer pricing report, it is to be issued as per the standard prescribed. by the relevant standard. If there is an audit report, it is to be under the Companies Act, it is as per the Companies Act. If there is a limited review report, it's as per SEBI requirements. So audit report issued is in the appropriate circumstance. So I'll use some terms as I go ahead, which is the engagement partner, engagement quality control reviewer, engagement quality control review. So these are some of the terms which I'll be using as I go ahead and discuss and do my presentation. So what are the terms that I'm using? Engagement partner. Who is an engagement partner? It is the person in the firm. He is a member of the Institute of Chartered Accountants, and he is in full-time practice and responsible for signing the financial report on the financial statements or whichever appropriate report, as we've just discussed. Then there is an engagement quality control review. This is a review which is performed by an independent person who's another suitably qualified person to perform the review. Technically, he should be a member of the Institute of Chartered Accountants of India. He should have sufficient experience and authority to carry out a review. So the review is to be carried out by a reviewer. And what is the review all about? That the person, the engagement partner who is carrying out the audit, he has done it in accordance with the relevant standards. The report is appropriately worded, and that the significant judgments have been taken into account and conclusions are appropriate. And keeping all that in view, that the report which has been issued is appropriate in the circumstances that it has been issued. And if there is any need for a modification, those modifications have taken place in the report. What is an engagement team? An engagement team is a team which works under the supervision of the engagement partner, which is the EP, which I said earlier. And this engagement team has to perform the audit in terms of the relevant standards that have been issued from time to time for the purpose of carrying out the audit. The firm is the firm of chartered accountants, which could be a sole person, a practitioner, which is a proprietorship or a partnership, or any other such entity which is permitted by law. Like these days, we have the LLPs, limited liability partnerships. So that is a firm which engages the engagement partner and the engagement team. There are inspections which take place for completed engagements, and there are certain inspections which take place internal as well as external by regulatory agencies or by the firm's internal control mechanism. So these are the various inspections which are referred to. Listed entity is an entity which is listed, which has shares of debt quoted on monitoring network firm. Network firm is a firm belongs to a network. Monitoring is how does the firm monitor its quality control procedures. Partner is an individual with the authority to bind the firm. Personnel are the partners and staff. Professional standards are as prescribed by the relevant authorities, whether it is the Reserve Bank of India, whether it is the Institute of Chartered Accountants, the Companies Act. So these are the professional standards that all practitioners work under. Staff are the professionals other than partners employed by the firm, and it includes experts. Experts could be non-chartered accountants, such as actuarial experts, or any other experts who opine on who provide assistance for the partner to opine on the financial statements. What are the leadership qualities for quality in audit? An engagement partner. So these are the leadership responsibilities. Responsibility of the overall quality. So at the end of the day, the partner who signs the audit takes responsibility for the work done on the audit. He is the person who is signing the accounts, and it is at the end of the day, if something is wrong, it is his responsibility. So he is responsible for the overall quality of the audit. Now, how does this take place? How does he make sure that the audit quality is of the relevant standard? There are messages from the engagement partner to the engagement team to emphasize on the professional standards, the quality, the importance of professional standards, legal and regulatory matters, compliance with the firm's applicable quality control policies. So all these have to be disseminated to the team. Now, how do these get disseminated to the team? These could get disseminated by verbal discussions or by holding trainings from time to time with all the staff members and the practitioners. Then he has to emphasize on issuance of the appropriate audit report and to do the audit objectively with the relevant skepticism in mind and raise issues without any fear or concern. If there is an issue, whenever in doubt, please go and consult. This is all which helps us to maintain quality, and quality is something which is non-compromising. Today, every second day, we read in the newspapers that NFRA has banned some firm, or it has done some quality inspections and found some problems with the firm. Make sure that we do minimize risk of any such inspection fails that we see in the press these days. So the other thing is that, having said that the engagement partner is infusing the sense of quality into all the individuals, it is very important for the engagement partner to remain alert to the evidence of any non-compliance by the engagement team. How does this happen? The engagement partner should have a continuous review mechanism by which either he has discussion with the firm, he observes certain things in the discussion with the engagement team, he does observation of how the engagement team works, he does periodic reviews of the work papers. So this is how he has to remain alert to any non-compliance. And if that non-compliance take place, he should then determine appropriate action, appropriate corrective action, so that the compliance takes place and consult with others in the firm as to how these non-compliances can be rectified. This is a very important thing from an ethical point of view. I'll just give you an example. What could be an ethical misconduct? A person, an individual or a firm is not supposed to take any services and remain indebted to the client. If the engagement partner gets to know by means of evidence or by verbal communication that somebody has taken debt from the company that he is auditing, he should immediately rectify it and he should bring it to the knowledge of the company or those charged with governance in the company. So he has to remain alert about any ethical non-compliances and take immediate action. What is the engagement partner's responsibility with respect to independence? We are aware that each and every member and the firm has to be independent of the client of the auditee. And when you say we have to be independent, it is not only that we do not have to have any debt from the company, but there are multiple ways in which we have to remain independent, which are prescribed by the ICAI. So that is something which the company has to see. And independence would mean that we do not have to render any services which are non-prescribed services, any financial relationship with the client, any of those matters which pose an independence threat or which can compromise the firm's position. There are certain responsibilities which the engagement partner holds. So there has to be a system by which independence requirements are met with. So that is something which is the engagement partner's responsibility. He should evaluate the circumstances that threaten independence, evaluate if there are any identified breaches of independence, determine that things have independence issues. If any individual is making the books of account of the company and is also doing the audit. So that is a clear independence threat because he is commenting on the work that he is doing himself. So this is what the engagement partner has to be very aware about. And if he determines that there is an independence threat, he should immediately take appropriate action to correct it. And in case he is not able to correct it, then he should report this to the firm And accordingly, the firm will take a decision as to whether they have to then go to the audit committee or the management of the firm to report that and see how to rectify that independence requirement. One of the most important factors in accepting an audit is the acceptance of a client or the continuation of a client relationship in case of audit engagements. The engagement partner and the firm have to be extremely cautious when they accept a client. Once a person issues an audit report, it is very clear that it gives its name to that particular company. There are certain procedures which every firm follows to ensure that the client meets the ethical requirements and is up to speed in terms of the ethics that the client follows. So the client has to be the engagement partner and the firm has to be satisfied that appropriate procedures are maintained for client acceptance. And then the conclusion that is reached to accept a client is appropriate. It is very easy to accept a client, but to deal with a difficult client may be extremely tough, particularly if the client is following certain unethical practices. So adequate skepticism has to be exercised at the time of accepting the client. If the engagement partner thinks that there is certain information that they would need to decline the engagement partner should immediately consult the firm and make sure that they do not accept the engagement, and this has to be appropriately conveyed to the auditee, the proposed auditee, that the reason as to why the engagement is not being accepted. Once having accepted a client or accepting an audit, the engagement partner has to be satisfied that the engagement team is suitably qualified to perform the audit engagement in accordance with the professional standards. Now, this is very easy said than done, that each of the professionals have the relevant experience, but one has to see the size of the company, the nature of the audit that has to be done, the industry in which the company operates, and if there are any complications with relation to any other matter which may come which the audit engagement partner may come across during the course of the audit. So that is why the partner has to, so keeping all this in mind, the partner has to ensure that the appropriate team has been selected to carry out the audit. They have the appropriate competencies and the capability to carry out the audit. This is very critical because in case the person does not understand the industry or the complications in an audit, he may not be able to do it. If there is a company which gives reports, it is relatively simpler to do an audit because goods move physically within the godown. There are controls which are time tested, which have been taking place over a period of time, and it is easier to do an audit as compared to a telecom industry where revenue is recognized by means of technology intervention. So there everything rests on technology. And one small slip in the IT system of the company may cause the auditee to suffer a big loss. So there, everything is done through technology, a different skill set of people. So similarly, in different industries and in different situations, certain specialists are required which may not be available within the team. So one has to be careful in selecting the team with the right experience and with the right knowledge. These are some of the responsibilities of an engagement partner. He has to direct the partners. He has to have adequate supervision on this entire team. He has to do periodic reviews. In case he is not able to come to a decision, he has to do appropriate consultations. He is responsible for the quality control review. And in case of difference of opinion, he has to consult and take the appropriate action. I will discuss each of these in detail. Direction means direction and supervision of the engagement, that it is done in compliance with the professional standards and regulatory environments, and the audit report issued is appropriate in the circumstances. This involves compliance with ethical requirements that the audit has been appropriately planned and performed. Where multiple partners involved, he has to make sure that relevant pay documents have been signed by the partners. The objective is clearly specified. The nature of the entity's business is known, which this is all what I've discussed earlier. The risk-related issues have been identified. Problems, that have arisen have to be solved, and a detailed approach to the engagement performance. How we have to engage how we have to perform the engagement, that is spelled out. In supervision, there has to be constant tracking of the audit. We have to consider the competency and capability of the individuals, and we have to give them, the partner has to give them sufficient time to carry out the work. There has to be a proper understanding of the instructions. The instructions should be, in writing. There should be audit programs by which audit has to be carried out. It should be carried out at plan. Every audit has to be completed in a finite period. For example, if it is a listed company, the audited financial statements have to be released by the company within 2 months of the year end. Like today, we are into March, so all audits for 31st in May. All audits for 31st March have to be completed by 31st of May and uploaded in the stock exchanges. So this is important that the planning is done in such a way. And there are large conglomerates which do audit, which have multiple locations where audit is done, multiple companies which get consolidated parent. So all that has to be done. So because of that, one has to make sure that the audit is well planned and that it is reviewed simultaneously as work goes on. And all issues that are significant are addressed in a timely manner. So you have to identify matters of consultation and consideration by more experienced engaged team members. So all this is part of the supervision which engagement partner does. Engagement partner's responsibility is to review, as I've said, constantly the work being performed in accordance with the accounting standards, and ensure that the entire documentation is appropriate. The work done is documented, discussions are documented, and the basis on which the conclusion for the audit report has been prepared, has been made, has been appropriately discussed and documented in the audit working papers. What are the issues that have to be addressed? That work has been performed in accordance with the professional standards and the legal and regulatory requirements. Significant matters have been raised for further consideration. Wherever required, consultation has been obtained from experts or from more experienced members within the firm. As one progresses in the work, depending on the complications that arise, there has to be appropriate consultation. One has to revise the nature and timing and extent of the work to be performed. When one plans and when one actually performs, there could be certain changes. So that may require the revision and the nature, timing, and extent of the work to be performed. Evidence obtained is sufficient and appropriate to support the audit report. Appropriate evidence has to be obtained. Lots of times I've noticed that when we do an audit, there is certain evidence which has been provided by the company. We take it on file and we file it or say we check the documentation. One has to see that it is the appropriate documentation. And this company check all the aspects that are required to be done in an audit for a particular transaction. The objectives of the engagement procedures have been achieved. These are the very critical elements which one needs to look at. Now, the engagement partner is to review certain critical areas during the engagement for the timely resolution. Critical areas of judgment. At lots of places, judgment is involved, and there is a reason based on which that judgment call has been taken by the engagement, by the client, by the auditee. So the engagement partner's responsibility is to critically address whether that judgment is appropriate. I'll take a small example. There is judgment in relation to whether a plant and machinery has a certain age, because based on that age, the depreciation will be determined. The engagement partner has to see that the judgment which has been used for the plant and machinery, for the life of the item of plant and machinery, whether it is appropriate. So the case which have been used in the past and defined by which the partner. So that is really the process is required. In the other thing is difficult matters which have been identified during the audit. Any significant risks that are there in the audit, management override over controls, and any other areas that are considered and important by an engagement partner. The report these days for listed companies also includes a matter on key audit matters, which also, the partner should look at himself and ensure that all the key audit matters have been sufficiently addressed. At times, there are certain contentious issues, and the engagement partner may need to go in for a consultation with another more experienced team member, whether he may be a technical expert or he may be an expert in the industry or has a lot of experience in carrying audits. So the engagement partner takes responsibility for the engagement team undertaking these consultations. He should be satisfied that the consultation has been taken and that the nature and scope of the conclusions has been agreed with the consultant, and also determine that the conclusions which have been reached are appropriate and have been implemented. So consultations is another very critical area. So these are all matters by which an engagement partner can ascertain that the quality has been appropriately maintained. Then there is an engagement quality control review, which is to be done, which is also a requirement of the standards on quality control. Now, this is carried out for certain companies which have been declared, which are listed companies, and any other engagement is the engagement which the firm determines that the engagement the quality control review is required. Again, it is the engagement partner's responsibility to ensure that for each engagement wherein EQCR is required, that the EQCR team has been engaged and that they have done the EQCR. The engagement partner should discuss all significant matters in the EQCR and not ensure that EQCR is complete before the date of release of the audit. Now, what is the objective of the EQC reviewer? The engagement quality control reviewer, he shall perform an evaluation of the significant judgment. So, what does the EQCR do? The engagement quality control reviewer, you have to ensure that all the significant judgments have been appropriately considered by the engagement team and the engagement partner, and the conclusions have been appropriately documented for each of these significant judgments made by the engagement team. And that, there is no impact on the audit report for any of these judgments. This would mean that there are detailed discussions of significant matters between the EQCR and the engagement team, review of the financial statements and the draft audit report. For doing that, it may be required that the EQCR may also need to review certain work papers based on which the significant conclusions have been arrived at, an evaluation as to how each matter has been resolved, and consider whether the engagement, the audit report issued is appropriate. Some additional considerations which an EQCR has to ensure is that the firm is independent in relation to the audit engagement. The EQCR has to ensure this thing also. Whether consultation has taken place on all matters which require to be consulted for, and whether the audit documentation for review reflects that the work has been performed with respect to significant judgments and the conclusion. So there's a very popular saying that non-documented, not done. The engagement quality control reviewer has to ensure that all the matters that have been raised or which have been considered as risks or have been considered as judgments, they have been appropriately documented together with the reasons as to why certain decisions have been taken in respect of those matters. Now, having said this, there may be differences of opinion which may arise within the engagement team, with the consultation team, and between the engagement partner and the EQCR reviewer. So it is possible that the engagement team may have a certain view, in which case they go to the engagement partner. The engagement partner can go to EQCR and the consultation partners. But there may be differences between the engagement partner, the consultation partner, and the EQCR reviewer. In which case, then the firm has to have a mechanism by which these differences are resolved by going to, by going to a certain person who's been designated to resolve the differences, who's the head of the quality control matters in the firm. So these also have to be appropriately documented. So the engagement partner has to consider results of the firm's monitoring process as evidenced in latest information circulated by the firm, and whether deficiencies noted will affect the audit engagement. So again, this is the engagement partner's responsibility. Now, what are the documentation requirements? We've discussed this as you've done this presentation, but broadly, the documentation from a quality control point of view has to be for issues identified, the conclusions reached in compliance with independence requirements or in compliance with the respective issues that have been raised, regarding conclusions reached regarding the acceptance and continuation of client relationships, and the nature and scope and conclusions resulting from consultations. So each of these things has to be documented in the audit file. In terms of the EQCR, what documentation is the EQCR required to do? It has to procedures. So in terms of EQCR review procedures required for policies. So policy in terms of EQCR reviews, whether the EQCR has been completed on or before the date of the auditor's report, and that the EQCR reviewer is not aware of any unresolved matters. So these are some of the matters that need to be documented by the EQCR. Having said that, this may sound a bit difficult, but this has to be implemented in spirit and in substance, not in form. So if this is done, I am sure with each of these steps, our quality control procedures would be up. That's all from my side, and I'm happy to take any questions from viewers of this presentation.
Thank you very much, Jitendra sir, for your insightful deliberation. Your thorough analysis and clear presentation have provided us valuable perspectives on the topic. I myself, being from a non-audit background, now feel so enlightened to know about the FRRB after this session. So now we have Amit Jain sir, who brings a wealth of expertise as a partner in Deloitte India's accounting and advisory practice. With the background as a graduate and a chartered accountant, he boasts over 17 years of experience in auditing, accounting, and reporting within the Big Four firms. Notably, he serves as a faculty member in the INDES and FRRB committee, demonstrating his commitment to industry standards and knowledge dissemination. His areas of specialization encompass a broad spectrum ranging from IPO readiness, capital market assistance to transactions and business disruption support, including mergers and demergers. Amit sir is sought after for his insights and assistance on complex matters such as financial instruments, business combinations, lease accounting, and revenue recognition, further solidifying his reputation as a trust advisor in the field of accounting and finance. So I welcome you, sir.
Thank you, Nikhil. Thank you for your kind words. And thank you, Jeet sir, for your insightful session. And we have gained a lot, much insight in respect of the quality control and how do we enhance the quality during the audit engagement. So really an amazing session.
Thank you
Thank
so
you
much,
for that.
Samir. Thank you.
So Nikhil, I will present my screen.
Sure.
Just give me a
Definitely.
moment. Let me know if this is visible.
Yeah, it's visible.
And I'm hoping that the slide is also moving.
Not yet. Are you moving it? Are you moving the slides right now?
Yeah,
Yeah, they are not moving, sir, right now.
not moving. No worries. I will try from my laptop itself then.
Okay.
Let me know if this is visible.
Yeah, it's visible, sir.
Yeah. Yeah, visible to everyone?
Yes, sir.
Okay. So hello everyone. I'm going to talk about couple of matters here. One is in respect of the NAFRA, right? So I will explain what is NAFRA. NAFRA stands for the National Financial Reporting Authority, right? So in last couple of years, we have seen that the NAFRA has issued couple of circulars on the non-compliance of the India's auditing aspects, right? So we will cover all those aspects. What are those circulars which has been issued by NAFRA, and we will understand how, as a part of the auditing process or as a part of the audit partner, we should capture all those things in our financial reporting while doing the audit. And even from the management perspective, it is becomes more critical that before sharing the financial statement to the auditor, they should review all those observations. They will ensure that those observations commented by the NAFRA has been very well incorporated in the financial statement. Second is I will be talking about the FRRB. FRRB stands for the Financial Reporting Review Board of ICAI. And in the last couple of years, FRRB has issued lots of observations in the financial statement issued by the company, and the audit assigned by the auditor and issued by the company on various matters like financial instrument, like Ind AS 101 first time adoption. Certain observation was in respect of the property, plant and equipment, which is the physical or tangible assets. Certain observation in respect of the separate financial statement. So we will be talking about Ind AS 27 in that scenario. Then we have certain observation on borrowing cost, whether a company can capitalize the borrowing cost in the cost of PPE or not. Inventory, government grant, impairment of assets, provision and contingent liability, intangible assets, and investment property. Right, so there are lots of observation which has been released by the FRRB in the past years, right? But these are the critical observation which I found after going the entire observation identified by the FRRB, right? So I will start from the NAFRA. So one is, what is NAFRA? NFRA. NFRA stands for, let me open the pointer as well so that the people can see where I'm talking. Okay, what is NAFRA? NAFRA stands for the National Financial Reporting Authority, right? What is NAFRA actually? So NAFRA is an independent regulator, independent body which has been constituted under the Companies Act, right? So Companies Act, Ministry of Corporate Affairs has the power to develop one authority, and they have developed in the past, I believe 2018 or 19, and the name to that authority has been given to a NAFRA, which is National Financial Reporting Authority. The objective of the NAFRA is to ensure that the accounting and the auditing standards have been appropriately complied with. The objective is to ensure that the audit profession, they are complying with the standards of auditing as well, right? So that's why the NAFRA has been formed. On which company NAFRA has been applicable? So NAFRA is applicable to all the companies which has been incorporated in India as well as which is listed company. right? Listed either in India or outside India, but the company should be incorporated in India. And to those unlisted companies who will follow this threshold, who will cover this threshold, for example, if any listed company having a net worth of 500 crores or more, it will fall under the purview of NAFRA. If any company having a paid up share capital of rupees 500 crores or more, it will fall under the purview of NAFRA. If there is an annual turnover of any company for the entire financial year, which is 1000 crores or more, it will fall under the purview of the NAFRA. So any company having this threshold, or any company which is a listed company, whether in India or outside India, then it will get fall under the purview of National Financial Reporting Authority of India. Right? If there is a non-compliance, right? So there is a penalty which has been described under the Ministry of Corporate Affairs Companies Act, which says if it is an individual, so 1 lakh to 5 times of the fees received. If it is a firm, 5 lakh to 10 times of the fees received. They have the right, they have the power to debar any member or any firm from 6 months to 10 years. And believe me, my dear friends, in the past couple of years, we have seen that the NAFRA have issued lots of circulars, lots of action has been taken against the local practitioner, against the different firm, and they have debarred those people to practice maybe for 6 months, maybe for 2 years, maybe for 3 years. Right? So it becomes very, very crucial for all the chartered accountant fraternity perspective, from all the company perspective, that we understand which company falls under the regulation of NAFRA, right? And how do we need to ensure the compliance of the auditing standards? How do we need to ensure the compliance of the accounting standards? Because if there is any slippage, we have NAFRA to answer, we have SEBI to answer, we have institute to answer, right? So it becomes very, very critical from the entire financial reporting perspective that we should be more vigilant, we should be more knowledgeable in terms of accounting standard compliance and auditing standard compliance. Right? Let me move forward. So one circular which has been issued by NAFRA on 10th October 2022. 10th October 22. That means last financial year of 31st March 23. So this is one of the classic case, and this case pertains to one listed company. What has happened in this case? The company has taken a significant amount of borrowing from the banks in crores. Significant amount of borrowings, but the company went into the losses. When the company went into the losses, the company is supposed to recognize the interest expense in their P&L account, right? And but at that point in time, company was unable to repay the amount of the loan to the bank. So what the bank has done, bank has classified that company as a non-performing asset, right, as per the RBI guidelines. And when the bank has recognized this as a non-performing asset as per the RBI guidelines, then the bank is not required to recognize the interest income, because those interest income would have been the doubtful income. Just by taking a plea that the bank is not recognizing the interest income, this company has taken a plea and a call that they will not recognizing interest expense in their books of accounts on the significant amount of the loan which they have taken from the banks, right? So, and this is a listed company, and they have published their financial statement. Auditor have signed their financial statement, and those numbers have got listed in the SEBI, right? So, and this financial statement has been picked up by the NAFRA, and they have seen, and it is a very, very basic principle of any financial reporting. If the loan has been taken, right, and the interest has to be recognized on those loan or the borrowing which the company has taken from the bank. Just by taking a plea that the company was that the bank is not recognizing, bank has recognized that loan as an NP, and bank is not recognizing the interest income, and company was into the discussion with the bank for the renegotiating the loan, it does not mean that the company should not recognize interest expense in its books of accounts, right? So what the NAFRA said in their circular, right, they have said it is a non-compliance of Ind AS 109, which is financial instrument, right? It is a big non-compliance of the financial instrument from the accounting standard perspective. The profit, whatever the profit which the company has reported, it was actually an incorrect profit, right? Incorrect presentation to the investor, incorrect presentation to the creditors, incorrect presentation to the lenders. The financial statement does not reflect the true and fair view of the financial position of the company, right? So this is what the NAFRA has said, that it's a significant non-compliance from the accounting standards, right? And NAFRA has taken an action against that company, and they have issued a circular, and they have said the company and the audit committee to draw attention on these aspects. And it is not only to that company. They have written that circular to all the listed companies and the unlisted companies, which comes under the purview of NFRA. Right, and they have forwarded the copy of that circular to 14 authorities like ICAI, Ministry of Corporate Affairs, Company Secretary, CII, SOCHM, and the other regulatory authorities. And they have mentioned in that circular that the company and the audit committee to draw attention. They have mentioned in that circular statutory auditor to draw attention on these aspects. They have mentioned in that circular that the board of director has to draw an attention on these matters. And they have mentioned in that circular that the bank has to maintain a memorandum books of accounts to record the interest on the NPA assets. Right, so it cannot be possible if the bank is not recognizing interest income because of the RBI guidance or RBI NPA norms. The company should not recognize interest expense. Company has to recognize interest expense in that case. If the loan has been taken, interest expense has to be recognized. So very basic principles of recognition of interest, which has not been complied by the company, significant non-compliance, and the NAFRA has issued an order on that. So this is one example, and this circular issued on 10th October 2022. Another classic case, and this circular has been issued by NAFRA on 29th March 2023. 29th March 2023. And this is in respect of the erroneous and the inconsistent accounting policy. And again, this is a classic case of one of the listed company. Right. So what happened? The case is in respect of the revenue recognition. The company has mentioned in its accounting policy that the revenue is measured at the fair value of the consideration received or receivable after taking into consideration the discounts. Right. And when the NAFRA is reviewed, when the NAFRA officers have reviewed this accounting policy, they said it is the accounting policy which is driven from Ind AS 18 and not Ind AS 115. And if you remember, my dear friends, Ind AS 18 Ind AS 18 was substituted by Ind AS 115 starting from 1st April 2018. That means almost 5 to 6 years have gone, and this company was using old accounting policy of Ind AS 18 instead of using Ind AS 115. Right, Ind AS 115, you must be aware of the fact there was a concept of the performance obligation. Once the performance obligation has been completed, only then the company is eligible to recognize the revenue. If there is any discounts, whether it's a cash discount, trade discounts, volume discounts, rebate, penalty, fee, bonus, which has to be passed on to the customer, that needs to be netted off from the revenue itself. Right. So the point here is we should be very vigilant. As an auditor, we should be very vigilant. As a management, we should be very vigilant that what type of accounting policy we are using. Are we using old standard? Are we using new standards? Right. So we should also be vigilant in terms of what are the amendment which is coming in. Right, from the previous year, 1st April 2023, there were a couple of amendments have been made by the Institute of Chartered Accountant on the Ind AS front. Significant accounting policies has been replaced with the material accounting policy. Right, so company and the people and the auditor and the management and the board should be aware of the fact what is significant, what is material. Right, so what significant has gone away and the material word has been used by the Institute of Chartered Accountant in their accounting policy. Right, if I give you a couple of aspects on that, generally companies write the definition of current and non-current in their accounting policy in the financial state. Right, current and non-current definition, everybody is aware of the fact. Even the 11th class commerce student is aware of the fact what is current and non-current. Right, and company uses half-page document in order to document their accounting policy. Right, so what is the use of documenting what is current and non-current? Right, instead of focusing or instead of giving a disclosure of half-page document on current and non-current, company can give a small paragraph what is current and non-current. Right, in respect of revenue, company gives very limited definition of revenue. Right, very limited policies on revenue. Right, so one of the example is company should see whether those policy are the company specific policy or whether those policy are the standard policy followed by the multiple or 100 companies. Right, so policy should be a company specific policy. Company should define each and every segment of revenue, each and every stream of revenue which is critical, right, which is material in its accounting policy. Right, so we all should be vigilant what is happening in the market. We all should be vigilant what are the key amendments which are coming up in the market. Right, another example of trade receivable. So NAFRA said the company is using the old accounting policy. For example, they have mentioned the trade receivable are recognized initially at fair value and subsequently measured at amortized cost less using the effective interest rate of method less provision of doubtful debt. Right. So they have said they are using something different accounting policy which is not written as per the Ind AS 109 of financial instrument. Right. And NAFRA said what should be the correct accounting policy? They have also mentioned in the circular the correct policy should be all financial assets are recognized initially at fair value, plus in the case of the financial asset not recognized at FETPL, transaction cost shall be attributable to the acquisition of the financial asset. And trade receivable which does not contain the significant financing component are measured at transaction price. Right. So the point is, are we following old standard? Are we following new standard? Whether my accounting policy is the company specific accounting policy, or are we using the general accounting policy which doesn't match with the company specific policy? Right. So this is another circular which has been released by NAFRA on the erroneous and the inconsistent accounting policy, and this was released on 29th March 2023. Let me move forward. And this was the circular. These two circulars have been addressed to all the listed companies, to all the unlisted companies which falls under the NAFRA purview, and to the auditors of all these companies. That means all the auditors of those companies which fall under the purview of NAFRA. These two circulars have been issued to all those people. Right. And further, this circular has been copied to Ministry of Corporate Affairs, to Director General of Corporate Affairs, to Reserve Bank of India, to SEBI, to IRDA, to ICAI, to ICSI, to CII, to Federation of Indian Chambers of Commerce, to SOCHAM, to PhD Chamber of Commerce, CFO Board, and the Press Information Bureau. To 13 authorities, NAFRA has shared and copied the circular to the 13 authorities. Right. So we should be very vigilant that what is happening in the market, are we compliant with, are we knowledgeable enough or not? Another circular which has been released by NAFRA on 23rd February 2023, and they have categorized their observation into the high, medium, and low. Couple of high observations are impairment allowance using ECL model has not been made. That means the provision for doubtful debt has not been created by the company in respect of the contract assets. So there is a guidance which is written under Ind AS 115 that if the company has recognized contract asset, which is generally an unbilled revenue, company need to test expected credit loss model as per Ind AS 109 on such contract assets. So this company has failed to do so, hence there is a high impact observation by the NAFRA. Second point, initial measurement policy with respect to trade receivable disclosure is not in alliance with Ind AS 109. Right. So initial measurement principles of trade receivable, appropriate disclosures have not been given as per the IFRS 9 or Ind AS 109. Full particulars of the terms and condition of loans to related parties have not been disclosed in the financial statement. Right. Significant payment terms, which is 30 to 90 days, have not been disclosed by the company in their financial statement, which is the requirement of as per Ind AS 115. So if you see small disclosures which are required by the respective standard, right, NAFRA has that level of understanding and knowledge that these are the critical things which the company is missing, which the company is lacking. Right. Even just a couple of months ago, February 2024, Institute has issued one detailed checklist on Ind AS on every standard. For example, Ind AS 115, these are the 50 points which needs to be disclosed in the financial statement. For example, Ind AS 109, these are the 20 points which needs to be disclosed in the financial statement. So for all the companies who falls under Ind AS regime, they should download those checklist from the ICA website, and they should ensure while preparing the financial statement all the disclosure which are required by the checklist, whether those has been disclosed appropriately or not. Right. This is a second check which the finance controller or the management need to ensure before handing over their financial statement to the auditor. Right. Because this becomes a dual check procedures in the company and the auditor. And very recently, just a couple of months ago, I attended one seminar organized by CII, where the NAFRA chairman presented, and he mentioned there are 5 lines of defense. What are those 5 lines? One is the management. Second one is the audit committee. Third one is the board of directors. Fourth one is the auditor. And the fifth one is the regulators. Right? So these are the 5 lines of defense which is available to any company. So first, the responsibility, first the onus lies only on the company, only on the management to evaluate, to disclose appropriately in its financial state. Right? Okay, let me move on. Another circular which has been issued by NAFRA on 20th July 2022. Right? Again, it has been bifurcated into high impact and moderate impact. First is company has given a corporate guarantee to bank to secure credit facilities. Such corporate guarantee has not been accounted for. If it would have been the Indian GAAP, there was no accounting which has been prescribed by Indian GAAP on respect of corporate accounting. It is only supposed to be disclosed in the financial statement as a part of contingent liability. But under India's regime, under IFRS regime, under US GAAP regime, we need to disclose the contingent corporate guarantee as a part of financial liability. Right. So this company must have failed to do so, and that is why there is an observation which has been given by NAFRA. Company did not make the required disclosure of employee benefit pension plan as per Ind AS 190. The company acquired overseas companies through one of its wholly owned subsidiaries, but did not disclose this transaction in the consolidated financial statement as per 103. So 103 deals with the business combination, 103 deals with the acquisition, 103 deals with the common control transaction. So if any company is acquiring the control over the another company, whether it is within the group, whether it's from the outside group, the accounting needs to be done as per Ind AS 103. The disclosure needs to be given as per Ind AS 103. If the company is doing the acquisition that means a company is acquiring another company from outside the group. Fair value accounting needs to be done. PPA allocation needs to be done. Goodwill accounting needs to be done. Deferred tax accounting needs to be done. Right? But if the company is acquiring another company within the group, which is under the common control, book value accounting needs to be done. No goodwill is supposed to be recognized. The difference between the purchase consideration and the net asset should be accounted as a capital reserve, and it needs to be disclosed accordingly. Moderate impact. The company has not disclosed the nature of the balance sheet items. So that means sometimes we have seen the company discloses lots of information within the category of others. Right? If the amount of others is material, the company is supposed to disclose what is others. Right? It cannot be the case the company just club it within the others and just go away. Most of the time we have seen the company clubs lots of transaction within the miscellaneous income. Right? But if there is a limit which is prescribed in the Schedule 3 that if it is more than 1% of the revenue, the company need to disclose that miscellaneous income separately. The company has to recognize the identity of that income separately. Right? So others, again, it is a judgmental. If the others is material, company is supposed to disclose that others. The company has taken a loan under a government scheme, but accounting of Ind AS or the disclosure under Ind AS 20 has not been made. Right? So these are some of the points which I picked up from the circular issued by the NAFRA in the past period. And you can see even the small points like the disclosure of the credit period of the debtor has been highlighted by NAFRA. Right? So these are a couple of the circular which has been released in last couple of years in respect of the Ind AS observations on the financial statement of some of the listed companies as well as the unlisted companies, but which falls under the category of NAFRA. Right. Next topic is the FRRB observation. What is FRRB? The full form of FRRB stands for Financial Reporting Review Board. It is an independent board within the institute. Right. So this board, what is the functionality of this board? So this board picks up the financial statement in the market on its suo motu, or they picked up the financial statement based on the direction given by the different authorities. The different authority may be SEBI, different authority may be Ministry of Corporate Affairs, the different authority may be NAFRA, different authority may be income tax, different authority may be any other regulatory authorities. Right? So based on that, FRRB picks up the financial statement for any particular period depending upon the permutation and combination, and they review it. And they see it whether the financial statement has been in compliance with the accounting standard or not. And even the ICA has a separate board of the peer review. They goes to the different offices of the auditor and they picked up the financial statement and they review what is the procedure which has been performed by the respective audit partner, respective firm on a particular engagement. Right? So FRRB is a function to review to review the financial statement from the perspective of accounting standard, whether it is old Indian accounting standard or whether it is the India's accounting standard, right? And the last year itself, this FRRB has issued couple of publication on that, and multiple observations has been identified both under Indian GAAP as well as under India's principles. And these are very important books, very important publication, which as a chartered accountant, which as a auditor, which as a management, we should purchase it and we should read it. And these are available for free on the ICAI website as well. Okay. So first point in respect of the FRRB observation is in respect of the financial instrument. So what I've done, I have collated all those observation and I've categorized those observation in respect of the standard. Financial instrument, maybe 20 observation, PP, maybe 5 observation, inventory, maybe 2 observation, right? So we are going standard by standard. So one is FRRB observation on the financial instrument. So one is impairment loss, non-compliance of the measurement and recognition principles of the ECL, right? So this FRRB is saying company has not complied with some of the key requirements relating to the impairment loss recognition and measurement principles. What is the measurement and recognition principle? If you read Index 109 financial instrument, there is a concept called expected credit loss. What is expected credit loss? That means if the company is of the view the amount of receivable is not supposed to be recognized in future, the company need to build the expectation. The company need to build a model how the company will compute the probability of default, how the company will inbuild that there is a credit risk involved. Basis that company needs to compute the flow rate, and basis that company need to reach out what is the expected doubtful debt in respect of the receivable in future. Right? Earlier under Indian GAAP perspective, we used to follow the incurred loss principle. That means once the debt has been bad, once the recoverability has been bad, only then we used to recognize provision. But now the expectation is company need to estimate, company need to expect that whether this amount is coming back to the company on timely basis or not. Even there is a default in receiving the amount on a timely basis, company is supposed to recognize the provision for doubtful debt. That concept is called expected credit loss model. And couple of years ago, ICAI has issued a EAC opinion as well. I've seen many companies who just takes the plea and they say that sir, this amount is recoverable from the government, right? And the government never defaults. Government always pay in future. There is no default from the government. In that opinion issued by the ICAI, EAC opinion, ICAI clearly said if there is a default, if there is a probability of default from the government, even then that such receivable should be considered for the perspective of ECL model testing. There is no exemption which is prescribed under Index 109. Right? Some companies you will find, they say, sir, this amount is recoverable from my holding company. This amount is recoverable from my subsidiary company. Hence, there is no provision is required. We just get the confirmation. That is not sufficient. If the holding company, if the subsidiary company is not making a payment on a timely basis, then it is subject to ECL provisioning. There is no exemption, there is no exception which is provided under Index 109 that holding, subsidiary, JV, associate or government authorities kept outside the provision. It is nowhere mentioned. So that means no exemption, no exception given under Index 109. ECL model is applicable to all type of companies. Right? And in this particular case, FRRB mentioned this indicates there is a complete lack of understanding of the accounting requirement of Indias relating to the financial instrument. That means ICAI is saying that the people don't understand. There is a complete lack of understanding on the requirement understanding of Indias relating to financial instrument. Right? So from the auditor perspective, management perspective, this is the area of concern. Incomplete disclosure of ECL. The company has major amount of trade receivable pertaining to holding company. As I mentioned earlier, there is no leeway, there is no exemption, there is no exception. Even if the amount is recovered from holding company, subsidiary company, associate, joint venture, fellow companies, government companies, no exception. Everybody will get covered under ECL model. Non-disclosure of the ECL on trade receivable. That means that the default is on account of the disclosure. It was viewed that when the trade receivables are shown as doubtful, the company shall disclose the amount of credit loss that is expected on those receivables. And it was noted the provision for expected loss has not been created for doubtful trade receivable. Right? So multiple financial statement has been picked up by the ICI in the past, and this is one of the common problem. Company is not recognizing provision for doubtful debt based on expected credit loss model. Right? Let me move on. Inappropriate disclosure on the derecognition of investment. So there is a requirement that if the company sells the equity investment which has been designated at FETOCI, FETOCI means fair value through other comprehensive income, right? Certain disclosure is required if the company sells its equity investment. What are those disclosures? The company has not given those disclosures. What are those disclosure? The reason for derecognition, the company has not given the reason. Fair value of the investment, the company has not given the fair value of investment. Cumulative gain and loss on disposal, the company failed to give the cumulative gain and loss on the disposal, right? So big non-compliance on the disclosure part. Another one, inappropriate presentation of investment in shares of companies under the head of inventories. So company has made an investment in shares. Company may be a broker company, right? Company may be a broker company. A company has made an investment in the different companies, maybe Reliance, maybe Bharti, maybe Infosys, maybe Wipro, maybe XYZ companies. And they have categorized all the investment as a part of inventories. Question is whether that is correct. Answer is absolutely wrong. Even under Indian GAAP, under AS2 inventory standard, it is written in a very categorically manner that if the investment has been made in any shares, it is not inventory. Under Index 2, it is written if the investment has been made in any shares from the perspective of the broker, it is not an inventory. And ICI in the past has issued a ITFG on this particular aspect and clarified that if a broker company is following Ind AS and they have made an investment in the different securities, in the different equity securities, debt securities, it is not inventory. It will be construed as a financial asset. It will fall under the chapter of financial instrument under Ind AS 109. So what happened? So since the company has categorized that entire financial asset into the inventories, it fails to give the true and fair view to the investors, to the SEBI or to the government authorities, right? Big non-compliance. Inappropriate presentation of interest accrued under the head of non-financial asset. Interest accrued is a financial asset. What is financial asset? Any contractual right to receive cash is a financial asset. Cash is a financial asset. Investment is a financial asset. Contractual right to receive cash is a financial asset. So since the company is having a contractual right to receive interest in cash or bank, it is a financial asset. But the company has wrongly classified this as a non-financial asset. Big non-compliance. Inappropriate presentation of prepaid expense and government authorities under the financial assets. If you read Ind AS 109, it is clearly mentioned that if you have a contractual right to receive service like prepaid expense, it is not a financial asset. It will be categorized as non-financial asset. Balances lying with government authorities. I will get the credit input. I will get the credit. I will get the input. Hence, it is not a financial asset. Big non-compliance by the company again. Inappropriate presentation of the treasury shares, right? What is treasury shares? So sometimes company makes an investment in its own company in the form of shares, right? Those shares will be used for the perspective of giving the ESOP to the employees. Those shares will be issued by the trust of that company to its employees, right? So under Companies Act, it is not allowed company can make an investment in its own company, right? This is like an investment in my own company, and it is not allowed to disclose the investment in my own company as a part of the investment asset category. Under Ind AS 32, it is clearly mentioned if there is any treasury shares, if the company has made any investment in its own company, it will be shown as a reduction from equity share capital itself, and it will not be recognized as an investment in my own company share as a part of investment or assets. Hence, it is again a big non-compliance by the respective company. Inappropriate presentation of the corporate guarantee. Company has failed to give the appropriate presentation of the corporate guarantee. Non-recognition of the guarantee. Guarantee, as I mentioned, under Indian GAAP, it was only a presentation and disclosure as a part of contingent liability. But under Ind AS, we need to give We need to record a liability of contingent liability. We need to record a liability of corporate guarantee in the financial statement. It is no longer a contingent liability, right? If it is a performance guarantee, that means I have given a guarantee of my own performance, then it would have been a case of disclosure in the contingent liability. But if I have taken a loan, if the bank has given a loan to my subsidiary and the guarantee has been given by the holding company, which is a corporate guarantee, which is a financial guarantee, that means if the subsidiary fails, it is the responsibility of the holding company to make the loss good to the bank. In that case, it is a financial guarantee, it is a corporate guarantee, and the liability of corporate guarantee is supposed to be recognized in the books of holding company at fair value. And the companies are failing to recognize, and the companies are failing to understand the basic principle of corporate guarantee now. Non-disclosure of purpose of corporate guarantee. So there is a requirement of Ind AS 107, which is financial instrument, that the objective and the purpose of taking the loan and giving a guarantee needs to be recognized and disclosed in the financial statement. This company failed to do so. Again, a non-compliance. Interest expense netted off from the income. So can we net off the expense versus revenue? Can we net off the income? Can we net off the asset versus liability? No, we cannot net off. We can only net off which has been only those transactions which has been permitted by the standard. For example, provision for doubtful debt needs to be recognized as a deduction from receivable. Provision for inventory obsolescence can be recognized as a deduction from inventory. Deferred tax liability can be recognized as a deduction from deferred tax assets. Right? If I'm operating as an agent, I can recognize the net income. But if I'm operating as a principal, I need to recognize the income on a gross basis. And therefore, if there is an interest expense with a different transaction, interest income with a different vendor, then it cannot be set off. And the company has done the setting off, which is again a big non-compliance. Inappropriate recognition of M2M gain and loss on derivatives. What is the accounting of derivative? What is derivative? Derivative like future, forward, options, cross currency swaps, right? Multiple currency swap, interest rate swap, right? So these are the derivative whose value derives from the underlying principle, underlying value, right? So what is the accounting of derivative under Ind AS? We need to record the mark to market gain and loss. That means if I settle this transaction as at year end, what is the amount I'm supposed to pay? What is the amount I'm supposed to receive? That is called mark to market, that needs to be recognized in the financial statement through P&L. That means the accounting under Ind AS is very clear, FETPL accounting. If someone asks what is the accounting of derivative under Indian GAAP, ICE issued a guidance note under Indian GAAP, and that guidance note was effective from 1st April 2016. That guidance note itself says any derivative which does not fall under AS 11, that needs to be recognized at fair value, and the MTM gain and loss will be routed through P&L. So that means the accounting of derivative under Indian GAAP and under Ind AS are both aligned. But this company failed to recognize the MTM gain and loss, hence a non-compliance. Rent deposits. So under Ind AS, the security deposit needs to be recognized at fair value, and it is a part of financial asset and not non-financial asset. Incomplete disclosures of liquidity risk, market risk, credit risk, and financial risk management, right? So under IFRS 7, under Ind AS 107, there are the multiple disclosure which is required, which is in respect of financial risk management, where we give the capital gearing ratios. Credit risk is required, where we disclose the aging of the receivable. Liquidity risk, where we give the disclosure of the maturity profile of my liability. And market risk, those are incomplete. Company has limited understanding on those basis, those disclosures or those requirement as per respective standard. No disclosure for the change in the business model. So if you see, Ind AS 109 is dependent upon the business model. Accounting is dependent upon the business model of the company, right? For example, amortized cost. Amortized cost needs to be recognized only if the company has a business model to collect the contractual cash flow, and that asset needs to be held till the maturity. If the company has an objective to sell the asset prior to the maturity period, right, and to collect the amount by selling, then the accounting will be FETOCI, right? So if there is a change in the business model, the accounting will get changed. If there is a change in the accounting, it needs to be disclosed why the business model has got changed, what is the triggering point of change of those business model, and those needs to be appropriately disclosed in the financial statement. And this was missing in that particular financial statement. Hence, we have a observation from FRRB. It was noted that a note to the financial statement borrowing that were various defaults in the repayment of loan. So multiple defaults have been done by the company on the repayment, right? And those disclosures have not been made. And the company has not made the further disclosure when it has been rectified. So multiple non-compliances, inappropriate disclosure of receivable from the redeemable preference shares, classification issues, non-disclosure of accounting policy of treatment of interest. Accounting policy is incomplete. Company has not given the accounting policy how to account for the interest income recognized in the financial statement, right? Which is the requirement of Ind AS 107. Right? These are the small non-compliances which has been identified from the disclosure perspective. For example, credit risk has not been disclosed, 12-month ECL have not been disclosed, exposure to liquidity has not been disclosed, financial liability number in the balance sheet phase with the schedule is not matching, interest bearing and the average settlement days has not been disclosed, exposure to liquidity risk has not been disclosed, sensitivity analysis of the interest rate risk has not been disclosed, collateral held for security not disclosed, nature and extent of risk arising from the financial instrument on liquidity risk, credit risk has not been disclosed. So n number of points in respect of the non-compliance of the disclosure and non-compliance of the accounting principles, which has been identified by the FRRB by reviewing the financial statement. When those financial statement has been reviewed, right, by the FRRB board, by the FRRB team, those can be easily identified. So this can also be picked up by the auditor and the management by reviewing their financial statement, because they must be having much more visibility in terms of the transactions, right? So it's a question mark on auditor's face, right? Why this has not been picked up? This is a question mark on the management face. Why this has not been picked up? Is there any intention to conceal those information? Is there any lack of knowledge? If yes, it is a lack of knowledge, then the people should gain the more learning. They should attend the more courses. They should read the financial all the accounting standards. They should comply the checklist principles as well, right? So all these disclosures, all these non-compliances is in respect of the only to financial instrument, right? So next is we have the non-compliance in respect of the first time adoption. What is first time adoption? If a company is adopting Ind AS for the first time, it's a basic principle. 10 years have already been gone. 2017 was the first year where India has adopted Ind AS, starting from 1st April 2015. Right? So if a company is adopting Ind AS for the first time, very basic principle, 3 balance sheet needs to be presented, 2 PL needs to be presented, 2 cash flow needs to be presented, OCI needs to be presented, accounting policy, material accounting policy needs to be presented, and all the notes to accounts related to the balance sheets for 3 years needs to be presented. All the notes to accounts pertaining to P&L needs to be presented for 2 years, right? And some reconciliation needs to be given, balance sheet reconciliation, equity reconciliation, P&L reconciliation needs to be given. That's a basic premise of the first time adoption of Ind AS, right? If you see couple of observations identified by the FRRB board, disclosure, Ind AS adjustment reconciliation of Indian GAAP versus Ind AS were not given. That means auditor and the management were not even aware of the fact what is required on the first standard of Ind AS 101, right? Basic premise was not aware of the fact. Explanatory notes of the first time adoption of Ind AS not given. Explanatory notes are silent as how the transition from the previous GAAP to Ind AS has affected the balance sheet, financial performance, cash flow as per the required standard. So people, management team, auditors unable to identify what are the problems, what are the disclosure which are supposed to be given. Big non-compliance, I would say. No third balance sheet reconciliation has been presented. It's again a basic premise that the opening balance sheet was supposed to be presented. For example, if let's say the company adopted Ind AS in the year 31st March 24, that means when the company filed 31st March 24 accounts to the Ministry of Corporate Affairs, that has to be under Ind AS, right? Comparative period would be 31st March 23, and opening date balance sheet would be 1st April 2022. these 3 financial period needs to be presented on the face of balance sheet and so on. So company failed in this case to present its third balance sheet. Again, I would say it's a big non-compliance. Requirement of opening balance sheet in the restated financial statement. Opening balance sheet, transition date balance sheet is missing. Investments. Investment transition from the carrying value to fair value not disclosed. So on the transition date, if you read Ind AS 101, certain exemption has been given, right? So 4 exemption has been given for investment. So company can take the carrying value, company can take the fair value, company can take the fair value as per Ind AS 109, and company can recognize at cost, right? So these are the 4 options which is given on the transition date, right? So company has to adopt which exemption company is going to take up, and appropriate disclosure needs to be given in the financial statement, which is missing in this particular aspect, right? So we should be very vigilant that what all disclosure needs to be required by a particular standard. Next is observation in respect of property, plant and equipment, which is tangible asset. Subsequent expenditure capitalization. So the company has written a policy that expenditure related to PP is added to the carrying value only if it increases the future benefit beyond the standard performance, right? So FRRB says this guidance pertains to old AS 10, which has been abolished, which has been withdrawn as on 1st April 2016. A new standard of AS 16, a new standard of AS 10 has been replaced by Ind AS 16, right? So what is the correct accounting policy? There is no criteria. It was viewed that the stated policy is not in line with the component accounting concepts, right? Assets can be capitalized only if there is an increase in the future benefit from the existing assets. So company is using the old standard accounting policy. No disclosure regarding the movement in the capital work in progress. So if you look the Schedule 3 requirement of the Companies Act, it simply says PP and CWIP, opening to closing roll forward of the current year and previous year needs to be given in the financial statement, including the accumulated depreciation as well. But these companies fail to give the disclosure of the opening to closing movement of capital work in progress. That's the observation. Depreciation on leasehold improvement, right? So depreciation on leasehold improvement is provided over the primary period of lease or the useful life, whichever is shorter, right? So FRRB has mentioned that the lease term assessment is inappropriate, right? The disclosure made by the company in the notes to accounts, it seems that the lease term has not been computed appropriately, right? Because if you look at Ind AS 16, there are multiple components which gets added in the computation of lease term. For example, rent-free period, non-cancelable period, right? Any renewal period where the lessee is reasonably certain to continue with the lease, and any termination period where the lessee is reasonably certain not to terminate the lease. All those period needs to be considered for the purpose of computation of lease period, and only then amortization or depreciation needs to be computed on those leased assets. So incorrect accounting policy. Toll equipments, incorrect classification. Company has classified the toll equipment as an intangible asset. We are talking about equipment which has been installed at toll, right? So observation is that it is not intangible, it is tangible in nature. Hence, there is a classification issues by the company. Project related expenses showed under CWIP, right? So there are certain expenditure which has been incurred by the company prior to the commercial operation, and company was capitalizing those costs which were in the form of civil works, machinery under erection, construction, materials, pre-operative expenditure. Till the date of commercial operation, company was capitalizing and put it as a part of the capital work in progress. So ICI says this is a wrong accounting principle. Why? Because under Ind AS or even under Indian GAAP, company is supposed to capitalize the asset or the expense till the date when the asset is ready for the intended use. If the asset is ready for the intended use today, and I am not using assets for next 3 months, even then those 3 months expenditure will not supposed to be capitalized, it will be charged to P&L, right? There's a concept of ready to use and put to use. under books, under statutory books, under Ministry of Corporate Affairs, under Ind AS, under Indian GAAP, we uses the concept ready to use for the intended use. But under income tax principle, we uses the concept put to use. So there is a difference between ready to use and put to use. Right? So in this case, what the company was doing, till the time the asset is put to use, company was capitalizing all the assets, all the expenditure as a part of CWIP or PP, which is not allowed as per the respective standard. Again, big non-compliance. Leasehold improvement charge. No depreciation has been charged in the P&L for the leased assets. Non-compliance. It has to be charged even under Indian GAAP as well as under Ind AS. So these are a couple of observations on the PPE side. Then we have Ind AS 27. Ind AS 27 deals with the separate financial statement. What is separate financial statement? That means if there is a holding company, if there is a subsidiary company, so standalone financial statement prepared by the holding company is called separate financial statement, right? If there is only one company, there is no subsidiary, no associate, no JV. That means those standalone financial statement prepared by that particular company cannot be considered as separate financial statement. So that means if there is a subsidiary or associates or JV, only then the standalone financial can be termed as separate financial, otherwise not. Right? So what are the observations? No disclosure of place of incorporation and the proportionate of ownership. So as per Ind AS 27 separate financial statement, company was supposed to give the disclosure of place of incorporation, proportionate of ownership of interest that was missing in the financial statement. No disclosure of the adoption of deemed cost of investment, right? Accounting policy of investment subsidiary was not in line with Ind AS 27. So Ind AS 27 simply says that if there is subsidiary associated in JV, there is an investment in subsidiary associated in JV that can be recognized at cost or fair value as per Ind AS 109. And parallelly on the transition date, as per Ind AS 101, we have the option either to recognize at cost, at carrying value, as fair value, one-time fair value, and fair value as per Ind AS 109. So company needs to appropriately decide either on transition date or subsequently what should be the accounting of investment, and that needs to be disclosed accordingly in the financial statement. So appropriate disclosure has not been made. That's why we are having an observation from ICI. No disclosure has been given, and therefore it is a non-compliance. Borrowing cost. Right? So under Ind AS, we have a concept of borrowing cost in Ind AS 23. Under Indian GAAP, we have a concept of borrowing cost as well as per AS 16. Principles are largely aligned. Right? So what is the observation here? Ready to use versus put to use. As I said earlier, borrowing costs directly attributable to the acquisition of fixed assets are capitalized as a part of the cost up to the date when the asset is put to use. Right? So this is a wrong accounting principle. We are supposed to capitalize the expenses or borrowing cost or both till the date when the asset is ready for the intended use and not till the date when the asset is put to use. It's again a non-big compliance because this is a settled issue even under Indian GAAP. This is on a new thing. Inventories. Inconsistency between two notes. Right? So amount which is given under inventory and the amount which has been shown under changes in the inventory of finished goods and work in progress in the P&L side, those were different. Because if you look at inventory, we only see in the balance sheet closing balance in the current year and the closing balance of inventory in the previous year as well, which is nothing but an opening number of current year. But in P&L, as a change in the finished goods, change in the work in progress, we give the difference between the opening and closing. And those numbers are not telling on the balance sheet phase. So there is an inconsistency which has been identified between the two notes. Valuation of inventories. So company has stated a policy that inventories are stated at lower of cost and fair value. But ICI said there's a difference between the NRV and fair value. Standard uses the term NRV and not the fair value. What is NRV? NRV stands for the net realizable value. That means fair value, selling price minus selling cost. But what is fair value? Fair value is only the selling price. So the wrong accounting policy have been used by the company. Disclosure. capital work in progress revenue account, right? There was no such account given under the Schedule 3 guidance, either under Indian GAAP or under Ind AS, right? Company should have recognized this as a part of inventory, as compared to the other current assets. So this is a non-compliance of the presentation aspect of Ministry of Corporate Affairs of Schedule 3 and a non-compliance of Ind AS 2 as well, right? So that is why we are having such observations. Ind AS 20, right? So this is one of the good observation which has been picked up. The company has received a government grant on account of the exemption received from the custom duty under the software technology park, right? So this needs to be accounted as per the Ind AS 20 principles government grant. However, the company has not applied Ind AS 20. Company has not give any disclosure of Ind AS 20 in its financial statement, and hence it becomes a non-compliance. Company has only given as a part of the commitment in the financial statement that this is a commitment which they have to fulfill in order to gain that custom duty benefit by doing the export obligation, right? So they have disclosed appropriately under other commitment, but they forget to account for as per of Ind AS 20, and no disclosures has been given in the financial statements. Impairment of assets, Ind AS 36, non-disclosure of impairment indicators on investments. So company has recognized the impairment loss on investments, but the disclosures why the impairment has been triggered, that has not been disclosed in the financial statements. Amortization of goodwill under Ind AS, right? Very basic principles of amortization. Goodwill is not supposed to be amortized under Ind AS, right? Under Indian GAAP, there are multiple type of goodwill. One is AS 14 goodwill, which is supposed to be amortized over the period of 5 years. One is AS 21 goodwill, which is not supposed to be amortized, which is only subject to impairment testing. Then is AS 23 goodwill. Then third one is the AS 27 goodwill. These goodwill are not supposed to be amortized. These are supposed to be tested for impairment. Similarly, under Ind AS principle, goodwill is not supposed to be amortized. Goodwill is only subject to impairment, right? But the company is doing the amortization of goodwill, and therefore it results into a non-compliance of amortization. And the Ind AS 20 and the Ind AS 36. Okay, provision, Ind AS 37. No discounting of long-term provision. So first question arises, do we need to do the discounting of long-term provision as per Ind AS 37? Answer is yes. What are the provisions which falls under Ind AS 37? Dismantling cost, right? Dismantling cost, site restoration cost, restructuring cost. So if any cost needs to be incurred, in future, which falls under Ind AS 37, we need to do the discounting of that cost, right? So, but this company has recognized certain provision other than the employee benefit, and they have not done the discounting of those provision, and hence it is a non-compliance of the Ind AS 37. So, company is supposed to do the provisioning of those standards. Ind AS 38, intangibles. Incorrect capitalization of expenditure on research and development. So, Ind AS 38 simply says any expenditure which has been incurred till the time of research, that expenditure needs to be charged to P&L. Any expenditure which has been incurred post the research phase, that means you have entered into the development phase, those expenditures are supposed to be capitalized. And any expenditure which has been incurred post the development phase, that means that when the product is ready, that expenditure shall be charged to P&L. Right? So that's a premise under Ind AS 38. That's a premise under AS 26 as well, right? And what the company has done, company is doing the capital expenditure on the research and development is treated as the fixed assets. So research and development phase, all the expenditure which the company is doing in the research phase, company is capitalizing those costs, which is not correct, right? That cost needs to be charged to P&L. So that results into a non-compliance of the accounting policy written in the financial statement, and it is a non-compliance of Ind AS 38. Incorrect disclosure or internally generated intangible into intangible under development. Company has not disclosed the appropriate accounting policy of intangible asset under development. So incorrect disclosures. Non-disclosure also results into a mixing information, and missing information means incorrect disclosures. Incorrect disclosure of lease of land in the financial statement, right? No disclosure has been given, which results into incorrect disclosures. Ind AS 40, investment property. So it simply says where the any land has been taken, where the property has been purchased by the company, and that property is used for the rental purpose, and that property is used for the purpose of capital appreciation, then that property should be accounted as a investment property. Company is supposed to charge depreciation on that property, right? So what has happened in this particular case? Depreciation on the investment property was not charged in the reporting year, but the depreciation on such investment property was charged during the comparative year. So company was charging the depreciation in the previous year, but the company is not charging the depreciation in the current year. It's a significant non-compliance. Investment property is measured at cost, less accumulated depreciation. Accordingly, depreciation should have been charged, but it was viewed that the requirement of Ind AS 40 has not been complied with, right? Big non-compliance. Disclosure. Investment property is measured at cost, less impairment. Any gain and loss on disposal is recognized in the P&L. Subsequent to initial recognition, investment property is measured at cost less accumulated depreciation, right? And depreciation is calculated using the straight line method. That's a policy which has been given by the company in its financial statement, right? So what's the observation here? The rate of depreciation or the useful life of investment property was not disclosed as per the paragraph 79 of Ind AS 40, right? So lots of observation on the investment property as well. So guys, what we have done, so my dear friends, we have seen that the n number of observation which has been released by FRRB board in the past, and those pertains to the financial statement disclosure, those pertains to the non-compliance of the recording of accounting entries, those pertains to the incorrect presentation in the financial statement. Couple of observation and circular which has also been issued by the NAFRA in respect of non-compliance of the accounting standard, right? Multiple seminars have been organized by CII, by institute, and other committees as well, right? To provide that level of guidance and knowledge, and sharing that knowledge to the chartered accountants to gain how to apply the standards correctly, to gain that knowledge to how to disclose the information required by the standards correctly in the financial statement, right? So as an auditor, we should be vigilant. We should gain more knowledge in terms of how to give a correct disclosure of the financial statement, correct disclosure of the particular item in the financial statement, whether it is required by Companies Act, whether it is required by SEBI, whether it is required by auditing standard, whether it is required by any other accounting standard framework applicable to the company. That's very, very crucial to make the financial reporting aspect more robust, right? And as I reiterate again, 5 lines of defense we are having. One is management, second one is the audit committee, third one is the board, fourth one is the auditor, and the last one is the regulators. So I believe I have been able to provide much level of insights that what are the key areas which has been identified by the ICA in the past, which is a pain area from the financial reporting aspect. I believe that you have gained a lot from this session. Thank you so much.
Definitely, sir. Thank you so much, Amit sir, for throwing light on the matter. You explained everything, taking up various instances which made it very easy to understand the subject. Thank you so much, sir.
Thank you, Nikhil. Thank you, Malvika. And thank you, Sanjeev sir, if Sanjeev sir is there and attending the session.
So we have a few questions as well.
Yeah.
It would be great if Jitendra sir and Amit sir could take them up. Okay, so to begin with, the first question is, so basically how FRRB selects companies whose financial statements are to be reviewed?
So 2 things. I have also mentioned this in my session and discussion. One is suo motu, right? Where the ICA believes that these are the couple of things which they need to review it. So one is the suo motu. Second one is they get the directions from the different authorities. One is, for example, SEBI, for example, Ministry of Corporate Affairs, for example, NAFRA, for example, income tax authorities, or maybe other authorities. Basis that ICA picks up the financial statement for the FRRB review.
Got it. Okay. So moving on to the next question. Next we have is EQCR partner responsible for any failure in the engagement?
Yes. Answer is yes. What is EQCR? EQCR stands for the Engagement Quality Control Reviewer, right? And generally, engagement quality reviewer have been assigned to those engagement which are complex, which involves material amount, right? And as per the direction, as per the guidance or the auditing standard board, once the financial statement has been finalized or during the course of the audit, key matters needs to be discussed with the engagement quality reviewer as well. Engagement quality reviewer is supposed to charge time on the engagement or during the engagement as well. I have read couple of the NAFRA report which has been up. I have read couple of NAFRA's report which has been uploaded on the NAFRA website. I'm getting some noises from the background, right? So I've read couple of NAFRA report which they have uploaded on their website. And when I read those observations in the past, one of the key observation was that when they picked up the financial statement of one company and when they have interviewed the auditors as well, right? Auditor was unable to showcase that the EQCR was involved. Auditor was unable to prove it that the EQCR consultation has been taken. There was no appropriate documentation which has been done by the engagement team that the EQCR was involved, right? So EQCR is equivalent responsible because he is reviewing the financial statement. For every decision which has been taken by the firm, by the engagement partner, EQCR is the second authority, right? As Jitu sir mentioned in his presentation that if there may be a inconsistency, there may be a difference of opinion between a firm view, between a EQCR, between the engagement partner. But as a firm, they have to reach to a single consensus, right? And that has to be justified through the documentation. So EQCR is also responsible if there is any non-compliance. I hope this is an answer to the question.
Perfectly, sir. Thank you so much. So next we have is basically I've been trying to understand the difference between SQ20 and SQC1, but more or less I found them to be almost similar. But I'm
Largely
sure there are
aligned.
certain differences.
Certain
Okay, so
differences, but they're largely aligned.
okay. So is there any specific certain motive to segregate both of these?
So it's
Obviously,
an
we know we
updated
have
version.
separation.
It's an updated version. Certain scope parameters have been increased, but they are largely aligned. So I need to check what is the exact difference which has come up. But I
Got it, sir.
I will check and get back to you on this separately.
Surely, sir. Thank you so much. So that's all from my end. Malvika ma'am, if you have any questions, you can take that.
Yeah, I have two of the questions. Firstly, there's a company that raised money through issue of compulsory convertible debentures by entering shareholder cum investor agreement, by virtue of which compulsory convertible debentures will be converted into equity at the option of investors. At balance sheet date, that option is not exercised, but in the balance sheet, CCB is shown as equity. Is it the right treatment?
Okay. So there are a couple of things, Malvika ji, which an auditor or the company has to evaluate, right? So first, I will talk about the technical aspect, right? So investor has made, let's say, 100 crore rupees investment in company A, and the company has issued compulsory convertible debenture, and let's say the period is 10 years, and let's say the interest rate is 10%, right? So that means after 10 years, this compulsory convertible debenture will get converted into the equity shares, and the investor have the right for the early conversion option. That means within the period of 10 years, investor can exercise its right at any point in time, right, for the early conversion option. Now here we need to evaluate and see what is the conversion ratio, right? Whether the conversion ratio is defined in the contract or whether the conversion ratio is dependent upon the fair market value when the conversion happen after 10 years. Right. So if let's say if the investor does not exercise its rights of the early conversion, and that means the conversion will automatically happens on 10th year. So that means conversion will happen depending upon the fair market value after 10 years. Second aspect is if let's say the investor exercises rights after 1 year, 2 year, 3 year, conversion will happen again on that particular day on the fair market value. So what I'm just trying to say, where the conversion is dependent upon the fair market value, it is a financial liability, it is not equity. But where the conversion ratio is defined in the contract, maybe 1:1, maybe 1:5, 1:10, that means one share will be converted, one debenture will be converted into number of equity shares is defined today, then it will take a form of equity. And then if let's say the conversion ratio is fixed, we call it as a fixed to fixed ratio. We call it as a fixed to fixed text criteria. And this guidance is given under Ind AS 32. And if fixed to fixed criteria meets, it will be a deemed equity. And we will show that CCD as an equity in the statement of changes in equity and not a financial liability. But if other scenario is if that ratio is not decided, it is dependent upon the fair market value on the date of conversion, then it becomes a financial liability and not equity.
Thank
I
you
hope
so
this
much
is the
for
answer to
answering.
this question.
Thank you so much. There's one more question. In terms of related party transaction, there's an unsecured loan from director, which is shown as the opening balance in the financials. Now the director expires and loan is transferred to his wife, who is not the director in the company. How to disclose this? Is it related party transaction? So that's a question that's been asked by one of the participants.
So there are a couple of things which happened, right? So when we disclose the related party transaction, we consider related party whether in current year as well as in previous year, right? So let's say Mr. A was the director and he was the director in current year. That means he was also a director in the previous year as well. I'm assuming that, right? So last year it was a related party transaction, but during the year that mishappening happened and then that gentleman passed away and the shares have been or the loan has been transferred or that asset has been transferred to his wife. Even in that capacity we should disclose it as a related party transaction, right? Because she was the nominee. And in the bracket as a asterisk we should disclose the entire fact that this has actually happened. And from the good corporate governance perspective, company is disclosing the entire transaction as a related party, right? And going forward, company needs to evaluate whether that lady is considered to be a related party as per the Section 2 of Companies Act, as per Ind AS 24, or if the company is following Indian GAAP, whether that is considered to be a related party as per AS 18 or not. But the disclosure, since he was a director in the previous year, related party has to be there and with the detailed disclosures.
Thank you so much.
Thank you, madam.
Thank you so much, sir. Thank you so much, Amit ji, for such a detailed deliberation. You have covered all the aspects. On behalf of WSB of ICL, I extend my heartiest thanks towards you for sparing your valuable time, as well as respected Jitendra ji in his absentia for such a wonderful and very thoughtful remarks in the beginning and very thoughtful presentation he has shared with us in the beginning. So thank you so much on behalf of WSB of ICL towards both the learned speakers for spending their valuable time in spite of very busy schedule and in audit meeting times and you have spare time. Thank you so much, Amit ji. And I also thank both the moderators for doing this webinar, for wonderful moderating this webinar, Nikhil ji and Malvika ma'am for their precious time also. So thank you so
Thank
much
you,
once
Anil ji.
again. I also thank all the participants of this. Thank you so much.
So thank you, Anil ji,
Thank you,
for giving me
everyone.
the opportunity to share my views on this particular aspect, right? And thank you, Nikhil and Malvika, for your wonderful moderation. And thank you all the participants for attending and for attending patiently this entire session. And I hope that you have gained lots of insights from this session.
Definitely so.
Thank you.
Thank you so
Good
much.
evening.
Thank you. Thank
So
you, sir.
much.
Thank you, everyone.